students, welcome to Legacy IAS Academy. Today we are going to discuss about a recent issue that has come into news is governments in several places, especially the government related to Aam Aadmi Party as well as Congress Party. They're again making this attempt to revive old pension scheme that was used to distribute pension or disturb pensions among the pensioners before year 2004. And we are going to discuss in this video that what is the new pension scheme that has been adopted by the government of India and later on by the state governments as well. What are the various pros and cons that we can think of if the old pension scheme is indeed revived? So first of all, if we talk about the reason why this issue is new, because the Congress and AAP both are promising, as elections are going to take place in certain states, including state of Gujarat, that they are promising the electorate that they will switch to the old pension scheme. And not even that, Congress already has some states where it has its government have revived old pension schemes, such as in the state of Rajasthan and Chhattisgarh. And at the same time, Aam Aadmi Party has said that it would do the same in the state of Punjab, where it also has formed the government. So the question that we need to ask, that is turning the clock back on the reform that happened almost 2 decades back, is a wise decision or whether it is a bad decision, wrong decision, both in the political terms as well as in economic terms. So this is the question we'll try to answer through the upcoming slides in this video. But before going into details about this, let us try to understand what indeed was the old pension scheme. So old pension scheme that was instituted or that was actually put into place until January 1st, 2004 was based on the principles of defined benefit scheme. What does this simply means? That the people who used to get pension as per this scheme, the salary which they used to get during the time or at the time of the retirement, the pension will be fixed at 50% of that basic salary. In simple terms, if suppose a person has retired and at the time of retirement his salary was rupees 10,000 per month, he will get a fixed pension of rupees 5,000 per month for entire his life. Not only that, only the pension was fixed up to 50% of the basic pay, but also like salaried persons of the government, salaried persons in, working for the government, they were also, that means pensioner, they were also able to get DA hikes. That means dearness allowance is a concept that is used by the government of India and also for the state government to make sure that the inflation can be indexed in the pensions and salaries of its employees. And that is when the inflation rises, when the cost of the services and the goods rises across the country, central government gives 2 times in a year hike in the dearness allowance, and this is something that was applicable not only for the salaried personnel but also for the pensioners. In short term, what we can understand that as far as this old pension scheme was concerned, the lowest pension that anyone was able to get after retirement was rupees 9,000, because 18,000 was the minimum salary of a central government employee and 62,500 was a maximum pension one was able to get, because that time 125,000 was the maximum salary of a central government employee of the cabinet secretary. So this was something that is related to the old pension scheme. So the problem and the concerns with the old pension scheme was this: for this scheme was based on the principles of pay as you go. That means there was an intergenerational equity issue. What does it mean? Is that the current central government employee will have to take care of the pensions of their older generation, of their last generation. And also not only that, the liability of pension was unfunded. There's no fixed corpus in which the government can dip their hand and distribute the pension. Every year, government has to come with special revenue, special resources to provide pension to its employees. The second problem was that it is obviously unsustainable in the long run. The reason is simple: because as more and more people retire, as more and more people are recruited, the pension liabilities of the central government and state government will keep on climbing, and this will become more deadly because, as we know, the India is on the path of development. The health infrastructure has increased, the healthcare facilities has seen a quite improvement, and also due to the improvement in nutrition and all these kind of things, increase in the life, increase in the quality of life, we are seeing increase in the longevity of the people of India as well. And as longevity rises, the government have to make sure that they are able to extend the pension payout for a longer period of times. So this was the reason why it can be understood to be unsustainable in the longer term. And third problem associated with OPS was there was no such future plan as far as the government is concerned. Government did not know that how they will pay year after year pensions in the future. They only were mainly we can say they were only caring about the pensions in that particular financial year. In next financial year there was no such plan for the government. So these were the three concerns that OPS had, and to tackle these concerns, later on government has come with the NPS. And to understand that to what extent the pension was a liability for the government, we can understand from this particular picture that between year 1991 to 2021, the central's pension bill had jumped almost 58 times to rupees 1,90,886 crore. Not only that, even if you look at from the perspective of state government, it has sort of more than central government 125 times, and the liability of the state government is almost 3,86,000 crores as far as the pensions are concerned. So it was not only restricted to central government or only few states, but all across in all the states of India, we can see the pensions used to constitute a large chunk of the tax revenue the government was able to get. For example, we can see in the state of Andhra Pradesh, the pension bill was almost 22% of the tax revenue of the state government. Similarly, if you look at the highest tax revenue was in the state of Himachal Pradesh, where almost 79% of the tax revenue was constituted for the pension fund or was needed for the pension fund. So what we can see from this particular picture, from this particular chart, that no state in the India had lower than 20%, 15% of the pension share as far as their tax revenues are concerned, and that is why there was limitations as far as the expenditure by the state in other areas, developmental works, other social works are concerned. And this is just we are talking about pension. If you include the salaries and the DAs of the current employees, obviously the figure for the pension salaries combined will go as high as 40% on average for each of these states, and that is why state also are suffering from the resource crunch, revenue crunch due to old pension scheme. So to tackle the problem, government came up with a solution, and the solution we can trace back to year 1998 when a OASIS project was initiated by Ministry of Social Justice and Empowerment. OASIS here refers to old age salary and income security. So what happened that in year 1998, the committee that was set up that actually took part in OASIS project, they come up with a figure that in India, almost 3.4 crore people, that is less than 11% of the estimated total working population of 31.4 crore, had some post-retirement income security. That means almost more than 85%, more than 88% of India's population do not come under umbrella of any kind of income security or post-retirement income security. So the main purpose of this project was to focus on, we can say, that the sector that is not covered by the government employment, whether it is state government employment or the central government employment. And that is why the committee has recommended, and two major recommendations of this committee was something that is very very important to understand. The first recommendation it gave was, rather than government footing the bill for the pensions of the employees, it should be the individual who should be given the opportunity to invest a part of their salary which they can later get on as a pension. So the recommendation was that 10% of the investment should be in the equity sector, which will be considered as safe. 30% of the we can say salary can be invested in the equity sector, and that can be called as a balanced portfolio. And other possibility is that 50% of the income can be invested in the equity, and that will be considered as a growth portfolio. Now, these are three possibilities. Individuals are free to choose depending upon their risk appetite. And also, this kind of equity funds will be floated by the six fund manager that had to be selected by the government. That was the first recommendation of the OASIS project committee. Not only that, it also said that post-retirement, after an individual is getting retired, at least 2 lakh from the retirement account would be used to purchase an annuity. Now, annuity is a scheme that when you purchase an annuity scheme, you pay a lump sum amount, and after that every month you are getting some fixed amount of money as your pension. So these were the two major recommendations of this particular committee. Now, the effect of the recommendation on this project process was that later on Department of Personnel and Training, they set up a high level expert group under the chairmanship of BK Bhattacharya, who was the chief secretary of Karnataka in earlier time. And after the expert group has been set up, they suggested hybrid defined benefit or defined contribution scheme. And there it says that every government employees, they should contribute 10% And similarly, employer should also contribute 10% from the salary, which should be keep on accruing upon, and after retirement this will the fund which can be used for providing pension to the employees. And it is on the basis of these two recommendations of project IAS and HLEZ, new pension scheme was floated by the government, and it was notified by the central government for the central government employees on the December 22nd, 2003. And for every person who is joining as an employee of central government after the 1st of January 2004 have to mandatorily subscribe for the new pension scheme. And under this scheme, it was decided that 10% of the basic salary and DA, that is dearness allowance by the employee, and similarly 10% of the same amount will be matched by the government, and this amount will be put into the pension fund, which will be keep on accruing till the time when the employee is working with the government, and after his retirement he can use this fund for taking it as a lump sum fund or also as a monthly pension. Later on in year 2019, government has increased this amount, and now this 10% figure has been increased up to 14% for the central government employees. Now, not only that, the government also said that individuals or the salaried personnel, they will have a choice to choose a range of schemes from low risk to high risk, depending upon the risk appetite, and also they can choose a variety of pension fund managers. Most of the pension fund managers are scheduled banks. SBI is there, Kotak Bank is there, Punjab National Bank is there. So an individual is able to choose freely that which fund manager he want to use for depositing his part of the income for pension. So this was the overall, we can understand, a structure of the new pension scheme. Now, as far as the new pension scheme is concerned, which is also called as national pension system, any person who is in the bracket of 80 to 60 years is eligible for that. There is a lock-in period, and the pension fund will mature only after you have attained the age of 60 years. After 3 years of account opening, there is a chance of partial withdrawal. That means 25% of your corpus you can withdraw for certain purposes, and you have different kind of asset classes you can choose from, such as you can invest in equity, you can invest in government bond, you can invest in corporate bond, as well as any alternative investment. Not only that, NPS account was made completely online, and it can be opened online at NSDL or Karvy website. The major advantage NPS offer is that it is very cost effective, because the low cost associated with the fund management is only capped at 0.01%. So two types of NPS accounts were opened. One was called as tier 1, other was called as tier 2. The difference between tier 1 and tier 2 account was that tier 1 account premature withdrawal was not allowed, and tax deduction benefit was given up to 2 lakh rupees per annum. Similarly, if you talk about tier 2 account has this flexibility. That means you can withdraw anytime the money from your pension fund. However, this can be withdrawn only after you have completed 3 years with this particular tier or with this particular fund for claiming the tax benefit. So this is how the structure of a national pension system look like. Now, what is the reason that the governments are willing, or governments are basically telling their electorates that they'll switch back to OPS? Because OPS has certain benefits that it offers, at least in the short term, both to the government as well as to the employees. The benefit that accrues to the government by adopting OPS is that the government, state government especially, they will not have to foot the bill, where they will not have to invest 10% of the basic salary and DA of the employee. That means they will not have to match the contribution of the employee. So here they will be able to save the money in the short term. Similarly, employees will also have certain benefit, because right now, suppose someone is earning 50,000 rupees, that is the basic and DA, then every month mandatorily he have to invest 5,000 rupees in the NPS. That means his take home salary will be reduced. But if the OPS is again adopted, then the take home salaries of the employees will become higher. So in short term, this also can seem to be advantageous for the salaried professionals. But these all are the short term gain, because no matter whether you are investing right now or not, at some point of time in the future you will have to foot the bill for the pensioners. Now, why switching to OPS can be considered as a bad? Because first of all, the old pension system totally depends upon the taxpayers' money. After retirement, there is a fixed income that every central government, state government employees is eligible to get. But this money is not taken from his account. This money is not taken from the his salary when he was working, but it is given by the taxpayers' money. Second, that also creates, as we discussed, intergenerational equality, because pay commission is constituted after every 5 and 10 years. And what pay commission does, it increases the salary as well as pensions and DA and all these kind of things. And that is why the pensioner who has retired 10 years back and the pensioner who is retiring right now or 1 or 2 years back, their pension reaches almost the same level. So that is the other issue where the revenue or the requirement of the pension fund become quite higher, and that actually causes resource crunch for both central government as well as state government. Third, we can say that this is something that is a tip of the iceberg. The problem is that just can be considered as tip of the iceberg, because bulk of the workforce, especially those working in the non-traditional sector, working out of these we can understand this contract sector, there is no old age income security, and the government also have to ensure that some sort of income security should be provided to them as well. And the government is spending most of its revenue in providing pensions and salaries to its current employees, obviously a large part of this workforce would be left behind. So these are some of the problems that the government can face if they switch back to the old pension system. So I hope you understood the concept of OPS and the new pension system. What are the pros and cons of both the systems, and what should be the right decisions that can be taken by the government in the coming time. So if you like the video, please hit the like button, share it with your fellow aspirants, as well as subscribe to our channel for the more helpful content. That is for this particular video. Thank you very much.